Hello, everyone. My name is Eric Lund, and I'm a senior economist at the Conference Board and the host of our Economy Watch series at the Conference Board. Welcome to the December episode. We have a great lineup for you today. We'll be discussing our economic outlooks for the U.S. and the U.K., as well as digging into global oil markets and the Gulf region. Some of the key topics for today, as I mentioned, discover how the U.S. and global economy are recovering amid the second wave of infections, receive expert analysis on the drivers of oil price fluctuations as the pandemic saps demand and governments consider climate change, and receive expert analysis on the future of oil prices as well. And then finally, we're going to be taking a look at the impact of oil prices and the pandemic on the Gulf region as well. As is always the case, we offer CPE credits for people who are watching. Make sure to stay online for the entire webcast. There'll be 3 pop-ups that occur over the next hour. Make sure to click on those, and you'll need to put your contact information into the box at the bottom of your screen. To help us tackle these big topics, we have a couple of fantastic guests joining us this episode. Sarah Fowler, joining us from the UK, is an analyst in international economics for Oxford Analytica. Welcome, Sarah.
Thank you.
We have Klaas de Vries joining us from Brussels. Klaas works out of our European office.
Thanks,
Welcome,
Eric.
Klaas.
Glad to be here.
Thanks, Eric. Glad to be here.
And then we have Hiba Atani, our senior economist for the Gulf, who's based in Kuwait City. Welcome, Hiba.
Thank you, Klaas. Eric. Nice to be here.
So as you can see, we have a very international panel today. We're going to get some great perspectives from different corners of the globe. And let's move straight into the content. First, we'll spend just a few minutes touching on the U.S. economy. But before we go into our most recent forecast update, we have actually a poll for the audience. So can we pull that poll up, please? So one of the key variables that we're looking at in the U.S. Is what happens with the vaccine, not just in terms of approval, but in terms of dissemination in the U.S. So our question is, as we approach the end of the year, it seems likely that one or more COVID-19 vaccines will be approved for use in the United States. At what point do you expect the average U.S. citizen to be able to secure an inoculation if they request one? So we know that we're all going to get some first frontline workers who are going to get inoculated first, and then some of the elderly. But in terms of the average person in the U.S., when will they be able to call up their doctor and say, I'd like to be inoculated for COVID-19? What are your expectations for that? Let's give the audience maybe 1 or 2 more seconds to decide. And let's lock that poll up if we can. Interesting. So it looks like about 42% of you expect broad dissemination in the second quarter of 2021. Almost an equal share are expecting the third quarter of 2021. 10% for the end of the year, fourth quarter, and then tied in last place, the first quarter of next year, and then 2022. So from our perspective, we make certain assumptions about this and a variety of other variables that we're going to get into shortly. But I think this largely dovetails with our thinking here in the U.S. Probably towards the end of the second quarter is our assumption. But I'm interested to see what the thinking is in other parts of the world. Klaas, you're based in Brussels. When do you think the average person in where you're living is going to be able to get inoculated if they'd like to?
Yeah, so I would say it depends a bit across countries. Well, Sarah can explain about the UK. They obviously already started vaccinating. The rest of Europe will probably follow very early on in January. I think the first half is probably a bit optimistic, at least in the country where I am in Belgium, and probably the rest of Western Europe as well. So I would go for Q3, Q4. Next year is probably a little bit too pessimistic, but yeah, that's what I would say.
I mean, as Klaus already mentioned, in the UK, I think yesterday people started receiving their first shots. The average person in London or in Manchester, when can they expect to be able to get a shot?
Yeah, that's right. There was a 90-year-old lady widely photographed and publicized as the first vaccinated. She was very pleased. I would agree with Klaus. I think Q2, Q3 for the average person not in a high-risk group.
And Hiba, what about you? I mean, you're in Kuwait City. What's the expectation among Kuwaitis and in the Gulf more broadly?
I think definitely for the average person in the Gulf, it will be around Q3 to Q4. Although we've heard news that we're going to start for Kuwait, we're going to start receiving some vaccines as early as Q1. But for the average person, I think it's not going to be before Q3.
Thank you. This is really interesting. I didn't necessarily expect sort of not pessimism, but a delayed expectation in Europe and in other in the Gulf as well. But what I'm hearing is maybe the U.S. might see a more rapid adoption or dissemination than in other parts of the world, which I find actually quite interesting. Let's go back to the slides because I want to talk a little bit about how this factors into our expectations for the economy and the recovery for next year. So at the Conference Board, we've this year done quite a bit of work on scenario forecasts. So as opposed to just having a single forecast for what we expect the economy to do, we actually have three. We have our base case scenario, which is sort of what we think is the highest probability. Then we have an upside and a downside. And there are there are five key kind of variables that we're assessing when we're thinking about this. We're thinking about the prevalence of COVID-19, what the virus is doing, if it's infecting more people, if the new cases are rising or falling. We're thinking about labor markets, what unemployment looks like, what consumption patterns look like, and that are associated with that. We're also considering government stimulus. We had a fair amount of government stimulus in the U.S. Earlier this year. Europe, of course, had some stimulus as well. So we're thinking about what happens in 2021 in terms of the next stimulus package. The vaccine, as I've already mentioned, is a really key variable as well. There's been good news on that over the last month or so. And then we were watching the U.S. elections quite closely. We were concerned that a lot of ambiguity in terms of the outcome might potentially knock business and consumer confidence. So let's move over to the next slide, and I'll explain sort of how these factor into what we're expecting to see for next year. So for that base case, we're expecting some flare-ups of COVID-19 in the U.S. Certainly we're seeing that right now, but we're not envisioning the large sort of kind of broad lockdowns that we saw in the spring. Our expectation is more sort of intermittent and temporary lockdowns. California, for instance, it seems is going to be adopting some version of that very shortly, if not now. But we're not expecting something on the national sort of level. In terms of stimulus, we do have expectations that we will see some stimulus this year. Next year. Nothing on the order of what we had in 2020. Maybe somewhere around 800 billion to $1 trillion, something in that order. Depends on what happens with the negotiations in Congress. But we don't expect that really sort of to hit the economy until probably towards the end of the first quarter or the beginning of the second quarter of 2021. With regard to the labor market, we're expecting no major improvements in the unemployment numbers over the next couple of months. As the intermittent lockdowns continue to roll out, there's probably going to be a pause in some of the recovery in the labor market. Indeed, we've already seen that in some of the recent employment numbers that have come out in recent weeks. And as a function of that, it's going to limit the flight path for consumption over the winter period. I mentioned the vaccine already. Approval is imminent. First, frontline workers are likely to get inoculated before the end of the year. That's going to start. But in terms of the average person, our expectation is probably not until the end of the second quarter, beginning of the third quarter. And at this point, I think the political situation in the U.S. is calmed for the most part. We expect a transition to occur in January and no knock-on effects for consumer or business confidence. So what this yields is a lull in the growth pattern over the winter, even perhaps a slight contraction on a month-on-month basis. But in terms of the big quarterly numbers that are reported on in the media, we're expecting probably about a 2.8% annualized growth rate for the fourth quarter, but then that to drop down to probably under a 1% in the first quarter. That having been said, as a lot of the variables that I just mentioned start to improve, the vaccine gets disseminated, the winter ends, the COVID rates decline as a function of that, the implementation of some sort of stimulus, we're really expecting the growth path to start to pick up in the second quarter and the third quarter especially. I think next summer we're expecting growth of about 6% in that third quarter. A lot of that I think is going to be funneled into services as opposed to durables. Consumers spent a lot of money on durables in 2020. They were locked down at home. They bought things that they could use at home. They invested in repairs and upgrades to their homes. But I think next year people are going to want to get outside during the summer. They're going to want to travel. They're going to want to eat out. And so the services sector, I think, is positioned to capture a lot of that strength. Upside, there's even more potential for improvement, as you can see in the orange line on the chart. And then there's still a potential that things could go south and that a vaccine doesn't get rolled out effectively. There is no stimulus. The unemployment situation doesn't improve, in which case we're looking at a much more dour 2021. In terms of the individual components of GDP, there's two ways to look at it. In the previous slide, this is based on the output of all the major industries in the U.S. This is sort of our industry model, and we do it on a month-by-month basis. But in terms of the more classical expenditure approach to looking at GDP, these are the numbers that are sort of baked into our current forecast, which has just been released this morning. I'm not going to go into the details too much on this. All that I would say is that watching the U.S. consumer, given the fact that consumption accounts for about 70% of U.S. GDP, the consumer is the closest thing to watch here. And so we do see some oscillations in terms of the spending patterns there. A bit of a lull, as I mentioned, in terms of the recovery over the winter, but consumption patterns really picking up during the summer.
Eric, there was a question on the labor market. Could you comment a little bit on, I guess, the unexpected strength of the labor market? The unemployment rate previously, I think we had expected it to be at a much higher level at this moment.
That's true. You know, our expectations in terms of the labor market recovery were a lot more pessimistic earlier in the year. We actually had a stronger summer period than we had forecast when we were coming out of the lockdown. We expected that sort of weakness to last a little bit longer, and it didn't in the U.S. So, you know, the labor market, as a function of that, recovered more rapidly than we had expected them to over that period. That having been said, if you look at the most recent job report that came out last Friday, a lot of that strength seems to have been sapped. We're not seeing that sort of flight path continue to rise. It's sort of more moving sideways now. And even the weekly initial unemployment claims figures that we've been tracking have really sort of run out of gas to a certain extent. So, I mean, as the lockdown, as these intermittent lockdowns and the virus get more pronounced over the winter, that recovery is likely to stay flat, if not possibly drop down a little bit. So we could see a little more softness in the labor market over the coming months before, again, things start to pick up in the spring of next year. And we have another question here. Would the lack of another stimulus be enough to trigger a double dip recession? That's a great question. As you can see in this slide, with the blue downside scenario, that is essentially a double dip recession. There are all five of our sort of variables are quite, we take a very pessimistic view there. So this doesn't just assume that there's no stimulus. It also assumes no vaccine. It also assumes unemployment deteriorates and some really disruptive political things early into 2021 as well. So no stimulus in and of itself may not be enough to cause a pronounced double dip, but certainly I think it's going to make the recovery pathway throughout the rest of next year a lot more flat. We won't see the economy come back to pre-pandemic levels of output in October, which is our expectation currently in that base case scenario. So pre-pandemic economy maybe not occurring until sometime in 2022 if we don't see some sort of a meaningful stimulus program come out of the Congress. But I've already taken too much time to talk about the U.S. We want to move on to the global economy and talk a little about what Klaus is seeing in terms of what's happening outside of the U.S. Klaus, why don't you take it from here?
Sure. Thanks, Eric. So you mentioned in the U.S. that Q4 is going to show some weakness, and especially Q1 because of the renewed COVID surge. I think for Europe we're a little bit more pessimistic on that. We're already seeing some of the data as the European economies went into another lockdown at the end of October, early November. We're already seeing some of the indicators dipping into negative territory. So it's likely that the Q4 growth rate is going to be negative for most European countries. That having been said, as you mentioned, for the U.S., it seems like the recovery is still ongoing, as you can see in this chart. Also for Japan, it seems that things are still going smooth. But also there, the cases have been rising in recent weeks. Also in some European countries, it hasn't been fully under control, the second wave in some countries. In some smaller countries, it's still even rising. So even for December and January, it doesn't look very solid in that sense, the outlook. So these are the mature economies. If we move on to emerging markets, it seems to be currently that they're in somewhat better shape. If you look at the purchasing managers, a majority of them signal expansion, judging from because it's above the 50 line. Of course, there is some variation here. We've seen very strong industrial production figures for Brazil, for China, Turkey. Some of them have actually already recovered all the lost ground, and they're continuing to grow. India and Mexico are also growing quickly, but they haven't fully gotten back to the sort of pre-pandemic output levels. In terms of retail trade, it looks a little bit different. Here, mature economies are showing much more strength, especially initially, probably linked to the greater fiscal stimulus and greater support of household income in mature economies relative to emerging markets. But still, again in Brazil and also in Turkey, retail trade has already recovered lost ground and again continues to grow. In China, they're just back to pre-pandemic levels, retail sales. And in some others, again, Mexico, for example, or South Africa, some of the other major emerging markets, they are growing rapidly, but it hasn't returned yet to the pre-pandemic levels. And as with some of the major mature economies, also in some a lot of emerging markets, actually, the cases have been rising again in recent weeks, perhaps with the exception of India. But in most others, it has been rising again, so that may mean all in all that for the global economy as a whole, Q4 and possibly Q1 also next year, we'll see quite a deceleration in growth. Now, how does it add up for next year? As we mentioned, on the vaccination, we assume that that will really start to kick in from Q2, Q3 onwards. And as obviously in the beginning, the most vulnerable part of the population will be vaccinated first. That will help to reduce the amount of restrictions that are put on the economy, right? Because it's mostly meant to protect the elderly and the vulnerable. So that will help reduce or help to return the economy back to a sort of more normal state, and that will obviously help the recovery especially from Q2 or Q3 and the second half of the year onwards. So on this chart you see basically our latest outlook, the 2020 and the 2021 growth rates. I should say we just updated it, so there's more information available from our website. Some of the latest numbers are there as well. Obviously there's a lot of uncertainty here. The 2020 growth rates, we have most of the data yet, so they will probably not change significantly, but obviously for next year there's a lot of uncertainty. Let me just highlight a couple of key challenges that I see. First is on the fiscal side. Obviously there has been a lot of support last year, and as Eric mentioned, in the US but also in other countries there are discussions about winding that support down. There's, I think, a lot of things that can go wrong there. Bankruptcies, for example, they have been really subdued so far, obviously because of all the support. If the support is being withdrawn too quickly, that can of course escalate. Bankruptcies can escalate unemployment, and that will obviously harm the recovery. So that's a big thing to watch. And then of course the vaccine distribution, right? So how quickly will governments be able to vaccinate the vulnerable parts, and in the end the entire population? That is of course a big unknown yet. So far things are going, I think, more positive than we thought a couple of months ago, but there are still I think a lot of uncertainties regarding storage or distribution and the whole logistics of it. So those are, I would say, are some of the key challenges. Eric.
Thanks so much, Klaus. We appreciate it. And as we all know, the roller coaster that we've been on in 2020 has had all kinds of implications for different asset prices. Here in the U.S., we've seen, for instance, surprisingly, a lot of real estate prices, especially in suburban areas, have actually risen quite a bit. But at the same time, energy prices, especially oil prices, took a pretty hard knock early in the year. And so with that having been said, I want to transition over to what 2020 has meant within oil markets around the world, and what 2021 could potentially lead to. So we're going to have Sarah walk us through this. But before she begins, and I think she has some really insightful thoughts to share with us, we want to get your thoughts, the audience. So if we could bring up our second poll. So global crude oil prices fell dramatically in early 2020 before regaining part of that loss later in the year. What are your price expectations for 1 year from now? So December 2021, are we going to see dramatically lower prices than where we are now? Lower prices? Prices about the same as where they are now? Higher than current prices? Or potentially dramatically higher prices for oil in various markets around the world? So let's give the audience just 1 or 2 more seconds to lock in their thoughts. Okay, let's go ahead and pause if we can. So about 45%, about half, no change from where we are now. Almost equally higher than current prices, so slightly higher, not massively higher. And then 7%, a little bit lower, and then 2% it's a skewed bell curve is what it is. On the tail ends, we have 2% dramatically higher and 2% dramatically lower. I think this sort of fits into our macro outlook in a lot of ways. We're expecting the recovery to continue into 2021, which would lead to more demand for oil. But let's ask some of the other folks that are with us today. Any response?
Yeah, actually, Eric, we've just released the CEO confidence for the Gulf region, and we asked our CEOs what do they see, how do they see the trajectory of oil prices in the upcoming 6 months. And surprisingly, we got the same results. We are around 44% for no changes in the upcoming year, and I think around 37% with slightly higher oil prices. So this is really interesting to see that even people from the region see prices as well being subdued for 2021.
That is interesting, Hiba. Thank you. And I think you have some material on that you'll talk about a little bit later in the presentation as well. Actually, why don't we just hand the reins over to Sarah and let her talk about what her expectations are. Can we go back to the slide deck, please? Fantastic. Sarah, why don't you go ahead and walk us through what you're thinking?
Great, thanks Eric. So I agree, no meaningful change or slightly higher prices once the recovery gains momentum. So let's start very quickly with a real quick whistle-stop tour of oil prices in 2020 before looking to supply and demand dynamics next year and then the energy transition. So in March, oil demand absolutely plunged as about 80% of the world's population was in lockdown and travel just ground to a halt. And OPEC Plus, especially Saudi Russia, disagreed about their response initially. Stocks surged, and as Eric said, prices took quite a hard knock, with the US West Texan oil price plunging negative one day. So later in April, OPEC Plus agreed to cut supply by 9.7 billion barrels a day, and this settled the market and the price. And the planned adjustment to reduce the cuts to 7.7 million a day from August went nice and smoothly. But last month, the planned adjustment to cut to 5.7 million barrels a day from January sparked a lot of tension at the OPEC meeting last week. So this came after the rise in COVID cases in Europe, North America, many emerging markets led the international agencies to revise down their demand forecast for next year. And reflecting this, OPEC Plus was expected to keep its supply cuts at 7.7 million barrels a day through early 2021. But Russia, Kazakhstan, UAE, Iraq and Nigeria were quite keen to produce more oil. And this prolonged the negotiations for a few days. And eventually they agreed to raise output by 500,000 barrels a day just in January, rather than 2 million for the whole of 2021. And from January, what they'll do each month, at the beginning of the month, is meet and agree to raise or reduce output by up to 500,000 barrels per day. So where does this leave us for 2021? The monthly reviews will allow OPEC Plus to adjust supply to match demand and to offset oversupply risks, keeping prices above $40 a barrel. But prices are unlikely to rise substantially above $60 because spare capacity remains high. It's only easing very gradually, and demand is very uneven. So global stocks fell in the third quarter of 2020 as demand outpaced supply, and OPEC expects global inventories to fall again in the fourth quarter. So moving into the first quarter of 2021, consumption is likely to be little changed, and inventories will fall again, although they won't reach their longer-term average until well into 2021. So I want to flag 4 factors influencing supply, and then move briefly to demand before the energy transition. So OPEC Plus is likely to stay together this year because all members want and need stable prices. The UAE is producing quarter to a third less than its capacity, and other members would also like to produce more. But at the same time, Saudi Arabia is ready to cut output more if demand falters, and these tensions will persist. So secondly, Libya is now back producing more than 1 million barrels a day and will continue this provided the ceasefire holds and the ports are not blockaded again. But a lack of maintenance and investment will make it difficult to increase output to pre-war levels of 1.4 million, so it's unlikely to have to join the OPEC Plus agreement. And then there's Iran, which is currently producing at around 300,000 barrels of oil a day. So its budget for 2021 seems rather optimistic, assuming oil exports of 2.3 million barrels a day. So this would require US sanctions to be fully lifted, and actually 1.2 to 1.4 million barrels of exports are much more likely. So the fourth and potentially biggest supply side factor is US output. So 43 US shale firms have already gone bankrupt this year, and the industry is not profitable until prices are well above $50. So producers need to invest just to maintain production. But prices of around $45 have supported modest rises in drilling recently. Forecasters expect US output to remain subdued at just over 11 million barrels a day next year, from 12 million in 19. But if the price settles above $50, US output could recover quicker, especially as is widely expected, vaccination is successful and the economy recovers strongly from mid-2021. Downside risks come from new President Biden tightening drilling regulations or the financial risks of many more shale producers closing. So looking quickly at demand, oil demand is recovering unevenly by geography and industry. Demand from Asia has picked up, especially in China and India, and this will offset modest demand from Europe and the United States during the increasing COVID restrictions. But more positively, purchasing managers' surveys in North America and Europe suggest the restrictions this time have not hampered activity nearly as much as in March and April. Indeed, global demand for gasoline and diesel is back to 90% of normal for the time of year. But in contrast, jet fuel demand remains about 50% of 2019's level. And vaccination inequality, as Klaus mentioned, intensifies this because most emerging markets are highly unlikely to be vaccinated by end 2021. So domestic travel is going to recover much earlier than global travel. Just today, a big cruise ship is stuck in Singapore as a passenger got COVID. And more remote working and less business travel may continue. Two factors that could increase the cost of air travel: less competition in the industry following all the bankruptcies, and governments taxing the sector to cut carbon emissions. So to just finish by highlighting a few things we're watching on the energy transition. Even though the International Energy Agency sees oil demand taking until 2025-26 to regain its pre-pandemic trend, under their base scenario, based on current policy plans, oil demand plateaus rather than peaks in the 2030s, and the Paris Agreement targets are not met. So they also have a scenario where decarbonisation ramps up in the next 5 years, and in this case, oil demand peaks by 2030 and then falls. But this scenario requires far more investment than is currently planned, especially in all the infrastructure to support electrification, which will be the world's biggest source of power by 2040. And on top of the spending needs just to protect against climate change impacts, which you can see in this chart, are much higher for emerging markets. Far more investment is needed in all areas of power systems just to cope with more of the world's energy being delivered as electricity. The risk post-pandemic, of course, is that budget and political constraints impede efforts to build back better in many countries. And even at low interest rates, the amount of debt countries are taking on means that interest rates will increasingly take a bigger share of government revenues in advanced and emerging markets, forcing spending cuts elsewhere. But ending on a positive note, renewable energy technologies have been building really strong momentum this year. Solar and onshore wind are now the cheapest forms of power generation. And global cooperation on climate efforts are a priority for new President Biden. So surging renewables and falling fossil fuel demand eventually does imply a loss of geopolitical significance for OPEC, and smaller producers are likely to suffer more because production could become more concentrated among larger, lower-cost producers. But we are talking decades here rather than a few years, because oil and gas is still going to be key to the energy transition. Thank you.
Thank you very much, Sarah. That was a very thoughtful presentation and discussion. I did want to ask a question from the audience, and you touched on this during your presentation. Well, we have Carlos Rivers who asked how the green economy of Mr. Biden affects the production of oil and gas in the U.S. And I think that you answered this to a certain extent in terms of longer-term energy transitions under a Biden administration or another administration that puts a lot of value on that. But in terms of the immediate sort of 1 to 2 year horizon, is a political transition from Mr. Trump to Mr. Biden going to seriously change in terms of policy framework that affects the calculus for oil and gas production here in the U.S.?
Well, I'm not sure it will massively, because although once the US oil recovery picks up momentum, I think there could be a lot more demand for more regulation on shale drillers. I think in the immediate it's not a big priority for Biden, and with prices quite low, it's low on the agenda, but the debate around that, investing a lot more in renewables, giving more momentum to the US green agenda, and at the same time maybe holding the US shale industry a bit back. There's so many issues around that. That debate, I think, could ramp up, but I think much more once prices rise and US output rises again, I think.
I think that's my thinking as well. I mean, the primary inhibitor to U.S. Energy production is I think more associated with price than it is with any kind of green economy policy. That's more of a structural sort of a trend that'll play out over the course of, you know, a decade or so, as opposed to sort of an immediate impact on energy prices coming into 2021. That's my perspective, at least.
Yeah, no, I agree.
I want to, so we've done, I think, a pretty good job of covering what has been happening within oil this year globally. Why don't we talk about how it's going to affect a region, specifically the Gulf region, of course, which has a lot of dependence on this on these prices. Hiba, what are your thoughts on 2021? The implications of some of the things Sarah has talked about. How is this going to play out in the Gulf?
Yeah, thank you, Eric. The COVID-19 hit the Gulf economies at a very pivotal moment. So they were just going out from the last oil shock in 2015. They were recovering. Everyone realized that they need to introduce comprehensive reform programs. They cannot depend on oil anymore. So we've seen the surge of Vision 2030, Vision 2035, and most of the Gulf countries, with no exception, actually. So they realized that they cannot rely on oil anymore, on oil revenues as a sustainable source. However, they always thought that we still have time. They thought the oil crisis is only temporary, and we always have time to implement, to support the private sector and the transition to an era that is less dependent on oil. So, however, we've seen like different application of those visions. KSA has been extremely focused, and they've changed even the structure of their public finances, their business environment, to include and vitalize the private sector. Versus Kuwait, that did little, although the vision is there, they did little in this domain. Maybe because there was no sense of urgency, given that their foreign reserves are four times their GDP. However, this time it's different. They realized that oil prices are not going to go up anymore. We're not going to see the 60s and 70s and even the 100s anytime soon. So the region suffered a dual shock. We had demand shock and a supply oil shock. The demand, of course, resulting from the restrictions and the containment measures, and the oil shock because they had to reduce tremendously their oil production to cater for oil prices. We expect a contraction of 5% in 2020, given that most of all 6 countries are oil dependent, to the exception of Dubai, which it has a different. It relies mainly on non-oil services. So basically, the government, the region actually, is used to funneling those revenues, the oil revenues, through 3 different channels: employment or overemployment of nationals in the public sector, hydrocarbon and social subsidies, and awarding mega projects to local private companies. So with the harsh outlook that we are currently facing, and the subdued oil prices that are going to remain in the long term, the region is facing high fiscal deficits, increasing debt levels, and they're trying extra hard these times to diversify and implement those reforms that have been, in nice presentations so far. So how did the government react? They went back to their old strategy. They wanted to defend the national employment and defend the private sector through awarding projects. If we look at the employment in the region, we have, according to the UN, we have around 35 million immigrant workers that are in 2019 working mostly in the private sector. So since 2015, the GCC countries have launched a nationalization program in an attempt to restructure the imbalances of the labor sector. Most of the migrant workers are in the private versus a high concentration of nationals in the public sector. So the labor market faces high rates of unemployment within nationals. The education system provides little skill to match the requests of the private sector and the competencies in the private sector. And of course, we have low level of employment of nationals in the private sector. So if you can see here, we have 76% of Bahrain's labor market mainly dominated by expat labor versus 81% in Kuwait, 76% in Saudi Arabia and UAE.
So Hiba, if I can ask a quick question. So could you comment maybe on some of the latest developments here? You already mentioned the nationalization policies in recent years, but also we know that very recently there have been an exodus of expatriate labor. How is that affecting the outlook, or do you think that will really hit growth? Because we know that the private sector has a lot of difficulties hiring the nationals? Or do you think that they will find a lot of ways around the system to still be able to hire those expatriate labor?
Yeah, thank you, Klaas. Actually, it's a very interesting question. Governments have imposed like a sort of quotas on private sector companies, given that they have to hire a certain number of nationals versus a certain number of expats. Those nationalization programs didn't seem to hit the target because companies found out several ways to manipulate this system. So we were faced with something called shadow phantom employment or fake employment of nationals. Although in the statistics, national statistics, you would see an increase in national labor versus an increase in national labor. However, this is not actually true. They are just hired on paper so that it will allow them to hire more expats. However, in the longer term, I think now with the government tightening the grip on those companies, we might start seeing definitely an exodus of expat labor. However, it's going to be slow. It's not going to be radical, like 20% decline in expat labor in the upcoming years. Because definitely the regions still rely on those expats for certain sectors like construction, infrastructure, and so on. So
I expect that this will probably impact remittances a little bit. Why don't you talk a little bit about how that relationship works?
Sure. So basically, what happened is, of course, we have this high correlation. Although on the left chart you can't see on the right chart, right? I'm showing the remittances from Saudi Arabia to the world versus oil prices. Although there is a high correlation, however, the correlation is higher on the longer term. It doesn't show on the quarterly basis. What happened is Gulf businesses have sought to pass out the impact, the cost of COVID into the vulnerable workers. So either by imposing unilateral pay cuts, replacing migrants with nationals, and this is something that has been witnessed in Saudi Arabia, in Oman, in Bahrain, and in Kuwait. So definitely with low oil prices, you're going to see lower remittances or flattening remittances in the upcoming 2 years. According to the most recent World Bank report, they expect a 20% decline in remittances from the region. Most of the main source, the GCC economies are major source of remittances for South Asia, Southeast Asia, and Central Asia, as well as for some countries from the MENA region, mainly Egypt. For Egypt in particular, which is the country that has the highest, largest recipients, we've seen a counter-cyclical trend as Egyptian workers were increasing a one-time transfer to their families back home because of COVID. So definitely there's going to be a decline.
Between the prices, the labor markets within the Gulf, and then the transmission channel vis-a-vis remittances into third countries. This web is really fascinating. I want to spend a little bit of time, because we have about 10 minutes left, talking about projects.
Sure.
And what the pipeline is in terms of investment projects, of course, which are incredibly important in a lot of these countries.
Yeah. Actually, the expat labor definitely would most of the expats work in those projects that are been awarded by the government to the private sector. As I said earlier, the government trying to funnel oil revenues to the private sector by awarding those projects to national companies. So if we want to compare the first 10 months of 2020 versus the awards that have been, the projects that have been awarded in 2019, we see a decline across most of the sectors: construction, transportation, Oil, of course, however, only the power sector is up to 107% year to date. However, also I want to highlight something. 2019 is not a great year to compare because it's even 2019 as a whole was much lower than 2018. So we've seen somehow a slowdown in awards. However, I think there will be a pickup because of the government's commitment to their vision 2030. If we compare here at a country level, KSA has a drop of 51% for the first 10 months of 2020 versus 2019. Although the government has announced early on their commitment to their mega projects on the Red Sea shore mainly, like Neon and so on. So those projects are not at risk. Definitely they will be hiring more expat labor to fulfill their commitments. The UAE is up 8% so far year to date. This is something that is related to Expo 2020. They're still finishing up some of the projects that were due last year. Oman and Bahrain. Bahrain, you should see it's up 36%. This is because it has received a support fund of $2 billion from its neighboring countries, and they have as well commitment with Saudi Arabia to finish up some of the construction and transportation projects. Moving on, going back to the poll question, we've done a survey for the CEO confidence. We've asked them back in November how confident are they with the current economic situation, and they are somehow cautious. The index is at 51. They think that still it's too early to decide if like currently versus the next 6 months, we are at 45%, so they are less optimistic about that. And in terms of the question of the poll, for the oil prices, as you can see here, 44% they see oil prices being flat in the upcoming 6 months versus 37% seeing it moving slightly upwards.
Yeah, this is fascinating, Hiba.
Yeah, it's the same.
It's also the audience poll.
Okay, and finally, if we want to have a look at the long-term impact of COVID, definitely in the upcoming 3 years, we see the region's GDP growth declining from 3.3% to 0.3% between 2020 and 2023, and slightly move up to 2% between 2024 and 2030. Capital quantity and labor will remain the driver for growth in the region, with improvement in digital transformation that will beef up productivity and total factor productivity. Thank you, Eric.
Thank you. Sorry, if I can ask a quick question. Could you comment a bit on how these figures look in terms of oil and non-oil production? You already touched upon it briefly. Obviously, that was a big driver in the last decades.
Yes.
Now with all the production cuts and in general the transition, how much is that playing into these numbers?
Yeah, so basically in the previous decades, while oil prices were extremely high, oil GDP definitely had a big contribution to the growth, and you can see the capital contribution, capital quantity being around 4% or 3% even. Now it's going to be reduced. Even they will have to invest a lot of time in changing the infrastructure and investing more in the power sector. However, they still did not figure out how they're going to invest in sectors that are more productive. Hence, we have this always the negative total factor productivity laying on in the background. So the lower oil prices in the long run will keep the GDP growth subdued at 2%, and I don't think if they are not able to decouple from oil, we're not going to see the 4% growth rate that have been seen previously.
I wanted to jump in here. So we have this kind of growth breakdown for the Gulf region. You've done a lot of work in this area. In terms of growth composition, sort of changes in Europe and in the U.S., what are we looking at in terms of the next decade? Are we looking at productivity increasing, capital contribution changes, labor markets? What's the impact of COVID
overall,
in Europe and in the U.S. longer
we
term?
think that there's even though economies will rebound, of course, either end of next year or beyond, depends a bit on the economy. But overall, we don't see in the longer term economies to really catch up all the lost output, basically. And we think that a lot of that is because of investment shortfall. So a lot of investment that has not happened in the last year, even though there will be a recovery, of course, there will not be enough investment to sort of bring the growth rates back to the previous levels. Now, overall, in Europe, we're a little bit more pessimistic than in the U.S. But a large part of that is because of what we call here as Hiba already commented on, the more the quantitative drivers of growth. We think that in the U.S. there's more room to grow the labor force. There's more room still to increase the capital per worker. So those are kind of drivers, or some of the drivers that make the U.S. potential growth somewhat higher, around just below 2%, I would say. And in Europe, it's more around 1 to 1.5% average per year.
Thank you. So we just have a few minutes left, and I wanted to get back to the audience. I see from Carlos Rivers again, we have a question. With this kind of scenario for production, how much will inventories be reduced? Sarah, did you have any quick thoughts on what kind of inventories we can expect
if we
on
come
the
back
horizon?
to this supply, demand and stocks chart, so inventories fell by 2.3 million barrels a day in Q3, expected about 1.7 million drop in Q4. I think in the first quarter of next year, we're probably looking at more like a million drop, or maybe less than that, and perhaps similar for the second quarter. And then beyond that, it's all a bit up in the air again, because we expect demand to be much stronger, so the supply calculus changes. But certainly we've kind of got a slow transition to getting the market back to normal by kind of the middle of next year, and then we'll see what happens after that.
Thank you very much, Sarah. So we're approaching the end of the hour here, so I'm going to close out the program. First and foremost, I want to thank all of our guests, Klaus, Sarah, Hiba. You've done a fantastic job. We've all benefited from your work and your thoughts. Thank you for sharing them. Of course, our audience, thank you so much for taking an hour of your day to spend with us. We hope you found some of the insights that we shared insightful. I want to encourage all of you to sign up for the 2021 series for Economy Watch. Registration details will be available quite soon. And of course, we're doing all kinds of work here at the Conference Board on COVID-19, the implications, not just for the economy, but in terms of human resources, human capital as well. Please make sure to see our resources there. Oxford Analytica also does some fantastic work in this space as well. We have a great podcast in addition to our Economy Watch program called Indications. If you have a chance, please stop by and take a listen. And feedback is always critical for us. We're always looking to make this program more applicable for people in business roles, leadership roles. Please share with us your thoughts on how we can improve. We're probably not going to see you until January, so enjoy your break. Have a happy New Year, and we'll see you in 2021. Thanks so much.